nice for some people in retirement. Again, kind of like the traditional IRAs, if earnings are pulled before 59 and a half, there's a 10% penalty plus taxes. However, it functions a little bit differently. So with the traditional IRA, it's based off the full amount since you got the deduction going into it. With the Roth IRA, it's just based off those gains that you had. So let's say you put $5,000 in and it grew to $10,000 and you pull out that $10,000, you'd only pay penalties and taxes on that $5,000. So I don't recommend pulling from either of these accounts unless you're age 59 and a half, but just to keep in the back of your mind, the Roth penalty is not nearly as bad as a traditional penalty. Next, going on to, well, which is better? I oftentimes get this question. I hate when people say this, but it depends. And the reason it depends is there's a lot of different factors that go into it. So I'll kind of guide you on some different thought processes that should go through your mind if you're looking at the different types of accounts. The first thing we look at is with the Roth, the question is, do you trust the government? And I'll point out right now, of course, we have a lot of government stimulus coming into the economy with COVID occurring. I mean, we've taken on trillions of dollars worth of debt. Well, of course, the government's going to need to pay that back at some time. They're going to need to raise taxes somewhere. There's been other politicians that have talked about taxing Roth IRAs. So I do caution people, it might be a tax down the road, which would really hurt the big benefit of the Roth IRA. I also point out Social Security years ago was actually supposed to not be taxed as well, ended up actually having taxes on it. And I do fear that the Roth could go that route as well, which again does hurt the benefit. The other thing we talk about with the difference here is think about the compounding of the tax deduction. A big mistake people make is when they actually add money to the traditional accounts, they don't look at what they saved in taxes. To really truly compare the two, you should think about investing that tax deduction you had. So let's say you had $1,000 worth of that tax deduction. That's what you had in savings on your taxes. In 20 years at about a 10% growth rate, that would be worth near $6,700. And just think about if you did that every single year for 20 years, you would have an immense amount of benefit from those tax deductions that you received along the way. And then lastly, talking about the current tax rate versus the retirement tax rate. Most people, when they're in their working years, are worried about retirement taxes. They don't realize, especially if in those higher marginal rates, you're not going to be paying those types of rates when you actually hit retirement. You have different types of sources of income, which generally lowers that marginal rate. So we generally tell people if you're in that lower tax rate, it's better to take advantage of the Roth. But if you're in that higher tax rate, those higher marginal rates, probably looking at the traditional is a much better method for your taxes. Next up, kind of continue on which is better. Clearly, as the tax rate grows, the deduction benefit increases. I just said $6,000 at 12% tax rate, you'd have a tax deduction benefit of $720, what you'd actually save on your taxes. At the 22% tax rate, you can see your tax savings would be $1,320. And at the 37% tax rate, you can see your savings would be $2,220. As I mentioned before, at the 12% bracket, we would recommend a Roth just because you're not getting a whole lot in the tax savings. And in retirement, the likelihood you're in that 12% tax bracket is quite low. So we'd rather take advantage of it at this time. Very important to note, plans can be used together, but rules do apply. There are income limitations for the Roth IRA. You may be able to contribute to both a 401k and a Roth. You may be able to contribute to both a 401k and a of accounts. With that said, if you can utilize both a Roth and traditional, it could really help benefit you. Because let's say you're on the cusp of that 22% and 12% tax bracket, a wise move to consider is let's say you had $42,000 worth of taxable income, adding about $2,000, we'll call it, to your traditional account will then push you down in that 12% tax rate. Then you can add the rest to your Roth accounts and you'd actually be in that lower marginal rate. So understanding where you kind of fit in those tax codes is quite beneficial to understanding your savings plan. On the next slide here, oftentimes you get questions talking about retirement accounts. Well, should you use retirement accounts to buy a house? The thing I point out here is retirement funds should be used for retirement. It's very important to note a house is a non-liquid asset. We had a client a couple of years ago, actually, she did a great job, saving up. She bought a house, but she completely bypassed saving for retirement. What happened actually when in her 80s, is she had no liquid money left, no way to pay the property taxes, the insurance, the maintenance costs that come with those houses. So she had to end up selling that house because she had no liquidity. Very important you have a balance between both. Also, speaking about pulling from retirement accounts, penalties and taxes can hurt your overall finances. There are ways to avoid penalties if you do pull out for a first-time home purchase. But again, you got to think about those taxes. If you pull out again $15,000 from your traditional IRA, that is now taxable income. So you're going to lose, I'd say, about 40% of that to taxes and penalties, which is going to be quite hefty come April of the following year for tax time. My feeling on buying a home is it's better to actually save for a house through an investment account. I think a lot of times people have buying a home backwards. They feel the need to buy that house right away because, oh, it's the right thing to do, but they overextend themselves and they actually weren't ready financially to buy that house. Then they are forced into higher costs. They don't have any savings going into it, and it really hurts their financial situation. The way I think about buying a house is you'd actually look at investing into an investment account, have that grow over time, make money in the investments, and hey, maybe it takes 2, 3, 4 years, but if you're financially ready at that time, you're a lot more emotionally ready to buy that house. You don't have that financial burden that you're concerned about. So it takes a little bit more time, but I believe financially it will reduce your stress quite a bit. Also looking here, it is important to find a balance between the 3 different types of accounts. Now I discussed that investment account for buying a house, talked about the Roth contributions, the traditional contributions. These are all great ways to invest and grow your net worth, but you really, again, have to understand how the different type of accounts impact your tax situation and which one is truly best for you. Lastly, always want to point out, don't forget about emergency savings. I see people sometimes, they want to invest everything, and that can be very, very dangerous. I like to keep about 3 to 6 months. I generally like about 3 months personally in non-discretionary expenses. That's things like housing, your car, food, water, things that you can't live without, of course. And you need to keep that in a savings account. One that I like to recommend is actually a Synchrony account. You get about 1% on your savings, which is better than some of the larger banks. It's still FDIC insured, but you're making a little bit more on the interest there. So you're not just having that sit idle for you. But emergency savings are very, very important because you never know if you're going to have that unforeseen expense. I mean, again, nobody saw really COVID happen, and some people that were living paycheck to paycheck were hurt quite bad by that. Or if you have, let's say, a car breakdown, you need to replace your tires, that could be an emergency savings use where you don't need to pull from the investment account. Reason is very important you don't do that. It's because the market moves up and down. You'd hate to have to pull out during a down period. It could really hurt your investment returns in the long term. Next up, talking about investing. Well, why is it important? Well, to begin, what is inflation? Inflation is the rising cost of goods and services. I like to point out here, think about the 1950s, think about the cost of college, think about the cost of gasoline, think about the cost of the movies. I know my dad always tells me you used to be able to go to the movies for about 5 cents. Right now we can't really go to the movies due to COVID, but before this, it was a lot more expensive than 5 cents, only about $15 to $20, I think is what I was paying. So that's inflation. As time progresses, goods and services do increase in value. What that creates a long-term erosion of your wealth. If you're not producing investment returns, you're actually losing net worth because you can't afford things down the road. Lastly, on this inflation side, look at the nominal versus real return. What we talk about here is the nominal return is your actual return for that year. So let's say you made 8% in terms of your investments versus your real return, that incorporates inflation. So if we had 2% inflation for the year, your real return on that 8% would actually be 6%. That's how you actually would look at your net worth growing in terms of real terms. And sometimes people do think long term that inflation, inflation is so mute right now. We're barely seeing any. It's not going to change. We'll have low inflation. That's a dangerous way to kind of look at your financial planning. If we look at long-term inflation from 1913 to 2018, you can see it's actually averaged 3.15%. And things can move quicker than you anticipate. In 1950s, I don't want to say it's a similar situation, but we did have low inflation where it was 1.8%. The 1960s, it was at 2.4%. And in the 1970s, you can see it jumped up to 7.25%. So over that 25 year time period, it extremely increased, which could have really hurt people if they were investing in, say, let's say long-term bonds, locked in interest rate. You're actually going to be losing a lot of your long-term net worth because you're not being able to keep up with inflation. Next up, talking about why is investing important? Compounding. Compounding is a great thing for your investments and your savings. Benjamin Franklin actually called it the eighth, no, excuse me, Albert Einstein's the one that called it the eighth wonder of the world, just because it is such an impressive thing that happens to your money. And what compounding actually is, it's the process in which an asset's earnings from either capital gains or interest are reinvested to generate additional earnings over time. To kind of further illustrate how compounding works, let's take a look at an example. Let's assume you invest $10,000 each year for the next 30 years at various rates of return. You can see over that 30-year time frame, had you left your money in savings, gotten that 1%, hey, you'd have $347,848.92. That's not bad. But if you invested, let's say at 4%, that would now jump up to $560,849.38. But if you actually invested properly, 8% is generally what we tell people. If you invest in a good type quality company, you can expect to earn that over the long term. At that 8% rate, you see that $10,000 invested each year would grow to $1,132,832.11. Again, a much larger sum than had you just left in the savings account. So compounding allows your money to work for you rather than you working for your money, of course. Next up, talking about, well, where do you invest your money? The first asset class that people typically look at is homes. And homes, they've done okay. Over the last 20 years, they've done 3.4%. You compare that to inflation, which has done 2.2%. The reason people like homes, though, it provides a tangible feeling when you're investing. When you go see it, you touch it, you can actually feel what's going on with that home. It provides people a little bit more comfort, I'd say, than other types of investments. The other thing about real estate investing in homes, you hear everybody that makes it sound so easy. Oh, I bought this home and I, doubled it in this time frame. And we all know somebody that's made money in real estate. But the thing is, investors forget about all the expenses. We had a client that actually they did okay on the home when they invested in it, but they forgot to incorporate, well, I did a $90,000 remodel. I forgot about the property taxes, the insurance on the property. There's a lot of different expenses that actually hurt your net return that people forget to back out. And lastly, when I point out homes, a lot of times people look at them at rentals. I will say renters can be a pain in the butt. You look at all the problems that can go wrong with the house. The house I'm living in right now, the sprinkler system got messed up and there's all these piping problems. Well, as a renter, I don't have to worry about that. It's the landlord has to worry about that. And we have clients that, approach retirement and they're done taking care of their rentals. They did okay on them in the long term, but they just don't want to have to worry about renting that out any longer. So it's just something to consider if you are thinking about rental properties. And I always do tell people, while I'm not a big advocate of investing in homes, you can make money in them. You just really have to know what you're doing. You have to take the time to do the research and understand the property, make sure you understand the market and so forth. And it's just, in my opinion, not for the average investor, but for the right person, you can do okay in them. Next up is bonds. Again, that bonds asset class has done 4.5% over the last 20 years. The reason people invest in bonds, investors believe they provide safety and income in retirement. The thing I point out to people is we're in the longest bull bond market in history. I mean, we've seen interest rates just continue to fall. And what happens is, as interest rates go down, bond prices go up. But I like to ask people, who believes that interest rates will increase? I'm not talking over the next 2 to 3 months. Nobody can really predict what's going to happen over that time frame. But I do strongly believe over the next 5 to 10 years, we cannot maintain interest rates this low. And just based on history, we'll revert to more of a normalized interest rate on the 10-year note and all the other borrowing mechanisms as well. The reason I point this out is on the next slide, you can actually see what happens if we do have a 1% rise in interest rates. And I like to point out the 10-year treasury here. You can see if we have a 1% rise in interest rates, you would actually lose 8.5% of your principal. That's not a great place to be investing, in my opinion. There are some fixed income instruments that we will use. I'll point out a floating rate fund. And a floating rate fund is kind of like a opposite of a variable mortgage, where if you get a fixed mortgage, your rate is fixed on that. The floating rate fund, like a variable mortgage, it does adjust over time. So we are able to kind of take advantage of increasing interest rates while also keeping a nice constant principal there. But for the most part, I do provide extreme caution on investing in fixed income at this time, just because number one, you're not getting very good interest, and number two, if interest rates do rise, a lot of people don't realize the risk that is associated with that. Next up is international stocks. You can see international stocks over the last 20 years has done 4%. The reason people like to have international stocks is generally part of an asset allocation strategy. So go to brokers or other advisors and so forth. They'll generally say, oh, we'll put X amount in US stocks, X amount in bonds, and then X amount in international stocks. But I'm not a big advocate of international stocks. Reason being is there's unknown accounting. Here in the United States, we have what we call GAAP accounting. You can really understand what's going on with those businesses. They're audited by the SEC, third-party firms. There's a lot of trustworthy information. But let's say a country like China. China is, again, a communist country, and they've had some issues as of late. I'll point out Luckin Coffee. Luckin Coffee, they had a huge decline in the stock market because they were also actually falsifying their sales, which is a big problem with these Chinese companies. How trustworthy is that data? And with every other country and companies in the United States, the SEC has access to those books. China is the only one that we do not. So I'd rather not take on that accounting risk. I'd rather buy here in the United States where I can trust the accounting of the companies. Below that is currency fluctuation. If you do buy a company, let's say on a foreign exchange, so you buy, let's say in Europe, well, now you're also taking on the currency fluctuation risk. So you can make, let's say, 10% on the stock that you buy. But if the currency falls 5% compared to the US dollar, well, now you've only made 5% on that stock. Now you're adding added risks, which I like to avoid as well. And then lastly, with international stocks, back in the 70s, we didn't have as much globalization. Companies weren't doing business overseas. But now U.S. companies do have those international sales. You look at those big companies, like Apple, like Microsoft, they do business all over the world. I'd rather let them take on the currency risk, let them hedge against that currency risk, and I'll invest in businesses like that rather than taking on the currency risk myself. Next up is equities, and you see over the last 20 years, equities have done 5.6% per year. It is the best performing asset class here. The reason people don't like equities is the volatility causes emotional distress. The up and the down, and it's moving, up 100 points one day and then down 500 points the next day, then up 1,000 points. All that movement panics people. But what we tell our clients is you're buying small pieces of large companies. Don't just look at the stock as moving up and down as a gambling chip. Look at saying, well, I own a small piece of JP Morgan Chase. And if you take that type of mentality, you're going to panic a lot less often because, again, you own something rather than just looking at that stock price moving up and down. As I mentioned, with proper understanding, equities can provide the best return over the longer term. And the nice thing with equities, too, is that they're pretty simple. Once you buy that business, do your research on it still, make sure you know what's going on. The CEO of a company will never call you to fix a leak. So you don't have to worry about, again, Jamie Dimon, the CEO of JP Morgan Chase, calling you and saying, hey, I need to come fix my toilet. So we like equities for that purpose. A lot of our clients as well don't have to do any of the management. They just like to see what's going on with the portfolio and don't have to do much like you would with, let's say, a rental. Next up is the benefit of dividends. The nice thing about dividends, and dividends are distributions that some large companies do provide to their shareholders. Most of them do it quarterly, some of them do it annually, but again, it's more common for them to do it on a quarterly basis. The reason we like dividends is it reduces risk and volatility. They're also taxed at substantially lower rates than ordinary income. So we went through all those different marginal tax rates earlier. Dividends are actually taxed at 0, 15, or 20%, depending on that marginal rate, which can be a big, big benefit in your tax picture. And lastly, companies may choose to use excess cash to initiate a dividend or increase their existing dividend payouts. We have a business we bought about 7, 8 years ago. The initial dividend yield we got on that company was about 3, 4%. But what happened is over that 7, 8 year time period, the company started making more money. Well, as they made more money, they distributed that to the shareholders via dividend. So now our dividend yield based off that initial cost basis is about 17%, a huge dividend yield. And that's what happens over time as companies make more and more money as they help those shareholders out. To provide a further example of how dividends do impact the portfolio, let's assume you invested $10,000 in 1960. We see that kind of goldish yellowish line. In 2018, at the end of the year, it would have been worth $431,397. But if you incorporate those dividends being reinvested, your portfolio would have grown to $2.459 million about. So dividends do have a huge impact on the returns of your portfolio. And then lastly, too, we do talk about the average investor. They've done just 1.9%, unfortunately. And a lot of common mistakes we see from people, letting your emotions kind of control those decisions. Sometimes brokers do provide poor products as well, poor advice there. So you have to understand, if you are working with an advisor, what is their strategy and does that make sense to you? And then another common mistake is people do leave too much in cash because they're fearful. Well, that is going to bring down your total return as well. We always tell people, don't be the average investor. Make sure you are investing in good quality type companies. On the next slide here, we talk about annual returns and intra-year declines. This kind of points out that, again, we know the stock market is going to be volatile. We know the stock market moves up and down. But what we do see here is, despite average intra-year drops of 13.8%, annual returns are actually positive in 30 of 40 years. So I like to point out 1987 as a great example. You can see the dot down here that was down 34%, is known as Black Monday, and stocks, again, were down 34% at one point during the year. Oh my gosh, why would you ever buy stocks? They're so risky. That's what you heard in the media. What you never heard was, had you invested January 1st and stayed invested through December 31st, you actually made 2% in the stock market that year. The problem was, people panicked, their emotions kicked in. They weren't looking at holding businesses. They were looking at saying, oh, my stocks are down, I better sell and get out. They sold out down here when things were down 34%. Then the following years, they missed out on 12 and 27% returns. We point out all throughout history, you can see over the last 40 years, you can see these intra-year drops occur, and they occur quite often. But 75% of the time, your annual returns are positive. On the next slide, we like to talk about actually understanding market volatility. And we find that when people understand what's going on, they're more common to actually stay the course and do proper investing rather than panic and sell when it's a poor time to sell. So let's talk about what market volatility is. If we look here, average trading volume on normal market days is 0.3%. So that means on that ticker tape, you see, the stock going up and down throughout the entire day. You only see 0.3% of those shares outstanding trading hands. You don't see the other 99.7% of shares that are being held by pension funds and longer-term investors. The right of that, you might be asking, well, Chase, what about the high volatility days? We've seen a lot of craziness in the market lately. How much does that jump up to? Well, it doubles, but it's still just 0.6%. So you're still not seeing the 99.4% of those investors that are long-term investors. Let's also not forget that up to 73% of the volume comes from high-frequency traders. So that increases the volatility. And those are people that are trading in and out for pennies on the dollar to try and get a little income. And another way I like to break this down for people is just to kind of put in perspective. If you own, let's say, or if you look at a neighborhood with 1,000 houses, well, if 6 people in that neighborhood had to sell in a fire sale because they had to get out and they had to sell that home, that would bring down the entire value of all those homes. Well, that doesn't make much sense. I'm not going to sell my house at that level. It's the same thing with stocks. If people took the same long-term perspective that they do with real estate as they do with stocks, I think they would do much, much better. And the way that we try and get people not to panic, and we tell them reasons not to panic at the bottom here, is know your investments and understand that you own businesses. Again, they're not gambling chips. Next up, you might be thinking, well, hey, I think I might be able to time the market and go in and out and take advantage before things drop and then get back in at the bottom. This is what we call 19 thoughts that lead to your underperformance. And this is what generally goes through a trader's head because they're not quite sure what's going on with the market. So we'll look over here at number one, see, the price is going up. Let's watch the market. Oh, at number two, the trend is holding. I'll buy at the next consolidation. See over here, number three, damn, I missed it. The stock moved up, missed the consolidation. But if I wait any longer, I won't profit from this trend. Let's buy it. Number four, good thing I didn't wait. Number five, you can see, I'll use this correction to increase my position. Number six, I want to increase it even more. It's brilliant. At this price, let's double it. And number seven, you can see, ouch, as soon as it goes back up, I'm selling out. Number eight, I don't believe it. It's down to 8.25. It's hit its absolute bottom. Number nine, you can see, okay, let's wait for it to recover. Otherwise, this will have to be a really long-term investment. Number 10, start to blame other people. What is the SEC doing about this? Number 11, enough, I'm selling out and staying out. Number 12, good thing I sold everything. Number 13, it's going to take again anyway. Number 14, starting to feel a little more confident. I told you so. Number 15, you what? Number 16, starting to get frustrated. What the hell? Number 17, more crazies who are going to get taken to the cleaners. Number 18, this is it. I knew this was going to happen all along. And number 19, drat. I'll buy in again. It's cheaper than last time anyhow. And we like to point this out just because when you trade, you start to just go off on all these different ideas. And we show this slide to clients that are, 50, 60, 70 years old. They oftentimes chuckle because they tried trading at one point, and that's exactly what happens. You don't have a purpose for holding that stock. And when the price movement starts to go against you, you don't really know what to do. And the other thing I point out is Peter Lynch, who is a famed fund manager for Fidelity years ago. He says more people have actually lost money trying to avoid the corrections by trying to trade and use options and different crazy things like that than actually going through and weathering those corrections. So our philosophy is if you own the right businesses, things are going to move up and down, but don't panic on those downturns. And the other thing I like to point out is John Maynard Keynes, who's a famed economist. He actually used to try to time market cycles based off of credit and people's psychology as well. It did not work out for him, and he actually had huge losses. He reverted to actually buying businesses and becoming a long-term investor. I always tell people if one of the most famous economists of all time cannot time economic cycles, what makes you think you can? Moving on to different types of investing philosophies, we're talking about value versus growth investing. Value looks for companies that are underpriced compared to the market, understand the valuations of a business. So you look at things like the price to earnings multiple, price to sales, price to book value. You want to say, well, how much am I paying for each dollar of earnings that company has? A great value company to think of is, those banks. Talk about JP Morgan Chase. There's some food companies right now. And right now I know I'm talking to the building association, but home builders are, in my opinion, a great value opportunity just with more people starting to move to the suburbs. There's a lot of pent-up demand for those home builders, and they also trade at phenomenal valuations. And to let you know, at our firm, we do stick to the value approach is what we actually utilize. The other approach that people look at is growth investing. And what growth investing looks at, you're looking for strong earnings and sales growth. So you don't really care as much about, I don't care about paying 100, 200 times earnings. I just want to see those earnings grow 10, 15, 20% per year. Some examples here is you got to think about Netflix, Amazon, and Tesla. Those are the two different types of strategies people can incorporate in the portfolio. Why do I like value? Beginning here, value has delivered better returns in down markets. You can see here, if you look back over the last, since 1979, the 5 worst years for the stock market, values outperformed growth every single year. In fact, in 2000 and 1981, value was actually positive while growth was negative. And if you look below that in the other chart, you can see the worst cumulative total return over 3 calendar years from 1979 to 2018. And 2007 to 2009, value lost about 24.5% of its portfolio. But if you compare that to growth from 2000 to 2002, you lost 55.5% of your portfolio. While I'm not saying I'm thrilled to lose 24% during that 3-year time frame, it's a whole lot more manageable than losing more than half of your portfolio. Another great example of why I don't prefer growth investing, let's talk about a company like Qualcomm. And there's many businesses out there right now that are riding this wave of, it's technology, it's the at-home trend, and it's just gone way beyond its means, in my opinion. Much like we saw during the tech boom back in the late 90s. And you see Qualcomm from 1998 to 2000, it went from under $10 a share to $88 a share. I mean, that is a phenomenal surge. But the problem is people started to ride this wave higher and higher and higher. They weren't really sure why they were holding it. And sure enough, if we look at the next slide, Qualcomm busted like many of the other tech companies. It fell from over $88 a share down to just about $17 a share a few years later. And for people that think, oh, I'm going to get out, unfortunately, a lot of times people start to get that emotional connection to it. We actually had I don't want to say associate or client, but an acquaintance that had $8 million worth of Qualcomm at its peak. And sure enough, when it started busting, she lost about 70, 80% of her entire portfolio because she thought it was going to 16 million. She had no reason for holding that company other than it had done well in the past. And the tech boom and bust was a terrible, terrible time for a lot of investors because they weren't looking at what they were paying for the companies. They were just looking at how the stock price had done. And it leads to, again, that trading mentality. And, oh, I'll wait for it to come back. And in fact, on the next slide, you can see how long it actually took for that stock to come back. You can see it has peak in 2000. It took about 19, 20 years for that company to reach that peak. And there's some people that, bought it when it was very, very low, and they still made money on it. But there is, unfortunately, people that bought at the top, and it took them years to recover from that disastrous loss. Next up, continuing on with value investing. Reason we like it, if you go back to 1926, you can see growth stocks have done 9.7% per year, but value has done better at 12.7% per year. Look at going back to 1979. Doesn't mean you're always going to be right, though, if you are doing value investing. You can see growth has outperformed value on the one-year time frame about 52% of the time. But as you expand that time frame out, you can see in that 10-year time frame, value has outperformed growth 62% of the time. Of course, being at the yGEN presentation here, most of you are going to be younger, so we have that long-term time horizon. I think right now is a great time to be looking at those value type companies. Next up, we talk about, would you fire Warren Buffett? Reason we like to bring up Warren Buffett is he is, again, a famed value investor. A lot of the principles that he actually utilizes, we have implemented at our firm. The reason we also like to bring him up is you're not always going to outperform the market. You have to be okay with making, I don't want to say poor decisions, but underperforming over certain time periods. To let you know, value has underperformed growth over the last few years, but we're not worried about because things ebb and flow. And what you can see here is even though Buffett's underperformed the market 50% of the time on an annual basis, he doesn't care because his philosophy is he's buying businesses and you close the market for 5 years. You see over that 5-year period, he's underperformed the market just 25% of the time. And over 10-year periods, he's actually underperformed just 10% of the time. And then lastly, what we point out is his outperformance from 1988 to 2019 is actually 350%. So what we always tell people is you have to be okay with understanding you're not always going to do great over a 1-week time frame, maybe not even a month, maybe not even a quarter, maybe not even a year, but over a longer term. If you make the right investment decisions and stay patient with it, you can do quite well when it comes to investing. With that, I did just want to kind of elaborate a little bit more. Most of the time talking more about business fundamentals, how we actually do the investing at our firm. Didn't have time to do that today. We actually do have smart investing webinars that you can view that goes in more detail on how we invest at our firm. You go to our website, smartinvesting2000.com, and register for those there. I will also point out on the next slide, I do have my email here. We just had our most recent webinar. We're taking a month off from them, but I do have a replay of that. So if you do want to actually view that webinar on kind of fundamental analysis and what we look at, I'm more than happy to send that over to you. Just send me an email to my email on file here, or you can also send me a note at our website in smartinvesting2000.com. That said, we'll open it back up to questions and we'll go from there.
All right, Chase, that was awesome. That was a lot of great insight. Thank you. I also think that you might have been inside of my brain for a little bit on the investor trend through there. So kind of not funny, but it is funny.
I mean, it's hard. A lot of people, a lot of times they just start to look at it, and especially right now, like things are pretty crazy. It's like, oh, it's going up. Oh, I like it because it's going up. And then, oh, it's going down. I better sell because it's going down. too much going on. That's why just kind of removing that stock price and understanding the fundamentals is why we do what we do.
That's awesome. Thank you. So SD asks, in order to contribute to an IRA with pre-tax dollars, does this need to be set up with your employer? Currently, I contribute to an IRA, then I reclassify it into my Roth IRA since I've already paid taxes on my income. And if I contribute to a Roth IRA directly, it has a limit that I will exceed, but no limit on reclassifying. Please confirm if this is something you agree with.
Yeah, so what this sounds like is this is what we call a backdoor Roth. And right now in the tax code, if you do fund a IRA with, after tax dollars, then you can reclassify it as a Roth IRA. And I believe that's the question that's being asked here. If not, more than happy to kind of address that in another way, but I believe that's how I'm interpreting that at the current time.
Yeah, I think she might be asking if she can contribute directly to a Roth IRA. That's the
Yeah. Okay. All right. So what actually happens there is it depends on your taxable income. So as I kind of said, if you do have access to a 401k plan, don't quote me on this, but I believe if you have taxable income over $120,000, you start to get phased out of being able to contribute to that Roth IRA. So that's why you might not be able to contribute directly. But if you have under that limit, then you should be able to contribute to a Roth IRA.
Thank you.
Mm-hmm.
Jeff asks, how much can you put into a Roth per year if you max out your 401k? So I think he's asking if well, it's pretty straightforward. Never mind.
Yeah, so the interesting thing about a 401k is it is treated separately from an IRA. So if you look at the IRAs, you're limited to that 6,000. You can only do, let's say, 3,000 into a traditional IRA and 3,000 into a Roth IRA. But if you fully fund your 401k, that doesn't impact your IRA contributions whatsoever. So you could actually do up to that $6,000 amount into a Roth as long as you fall within those income limitations.
Thanks. Jeff also asks, what do you think about setting up automatic withdrawals from your paycheck or bank account every month that buy stocks or mutual funds? ComputerShare does this kind of thing. Please comment.
So I like the idea of automatic withdrawals. That's one thing people like about 401ks is because it just kind of goes and it's just on autopilot. You don't really have to think about funding it. Don't have to get caught in that decision of, do I want to buy that, new toy or do I want to invest for the future? It automatically pulls it out. You have to kind of bake it in. So I like the idea of automatic withdrawals from your paycheck or bank account every month. Actually buying the individual stocks or mutual funds. The mutual funds, I kind of like that idea just because it's pretty consistent. You do get diversification that way. To let people know, I'm not a huge fan of mutual funds, really beyond $5,000 of investing. I like to buy the individual equities, but I will caution people buying that individual stock every single month could be okay, but you also could be buying high, which can be dangerous. So you would have to reevaluate that stock every single month. Personally, what I do is I put money every single month into my investment account and then evaluate at that time, where should I be investing it?
That's great advice. One other, if I can touch on it as well, obviously I'm not in the industry, but there are some apps that will allow you to kind of set up your own mutual funds. And so you can buy tiny portions of it. And that's one option. Another option is to get a financial advisor who you then contribute to, and they would make those contributions on your behalf as well. And Chase would, I believe, be one of those people.
More than happy to answer any questions on that if people are interested in talking further on that. But yeah, some of the apps are quite useful. And I always tell people too, I mean, if you're saving in the Roth or traditional, you're taking a good step in the right direction because you're saving and investing. I do just kind of warn people, be cautious of what you invest in. It can be dangerous. I mean, as you saw with the tech boom and bust, a lot of people did well for many, many years. And all of a sudden they lost their shirts. People lost 70, 80, 90% of their portfolios because they were so invested in tech. So, while you're taking the great first step of investing, just be cautious, what I tell people.
Great. Thank you.
Of course.
Does anyone else have any questions for Chase at this time? Do we want to open it up? Or are we good to go?
Looks like we're good.
I think we're good. Cool. Thank you, Chase. I really appreciate your time today. all your insight. That's great. And everybody, make sure you check out Chase's webinars. I watched one the other day, and it's pretty great as well. So.
Well, thank you.
Thanks, Chase.